It does take us to our talk of the tape. Can stocks post a fourth consecutive strong year? Well, let's ask our panel. Solis's Dan Greenhouse, New Edge Wealth's Cameron Dawson, iCaptial's Sonali Basak. Great to have everybody with us. Dan, you first. How are we set up for this new year?
I think we're set up pretty well. The trends in place at the end of last year, stronger earnings growth, the AI story remaining intact, and the Fed being accommodative rather than restrictive, plus the purchases, some of the reserve purchases that they'll be doing, continues, I think, the sort of macro tailwind that's been driving markets higher and probably does for the immediate future.
So we finished the year with a little bit of a whimper. We're watching the tape, as I said, closely today. We're at 69.01. Jonathan Krinsky of BTIG says that we need to close today above 69.09.79 to avoid a negative Santa Claus rally. The last 2 years were also negative, and there's never been 3 straight negative Santa Claus rally periods. Yeah, Put any credence in that?
I love John Krinsky. So what? So it's never happened before. So what if it happens? So what?
Means nothing for how any part of the early year will trade?
I don't think it matters one bit.
Why do you think we were a little weak into the end of the year?
Listen, I thought we were going to get to 7,000 to end the year.
Okay, why didn't we?
Well, we've had the AI rotation story, which sort of hampered, hampered some of the larger cap names, which put a little bit of downward pressure on the market. And while there was a rotation, we know that banks and healthcare picked up some of the slack. I think that probably mathematically held back the market a little more than I expected and other people expected. But again, I don't know that I would read too much into that. And again, getting back to John's point, obviously I would rather a positive Santa Claus rally than a negative one, but I also don't think it really necessarily matters given some of those aforementioned tailwinds I mentioned.
I don't feel like, Sonali, you're expecting that much out of this year in the stock market. Single digit, albeit mid to high single digit returns.
Not to say we can't outperform that. We think it's a constructive year. There's a positive backdrop, but we think it'll be choppy, Scott. You look at this year, why didn't the market perform at the tail end of last year? A few things. The selectivity in the AI theme, we've been talking about it for a while. We can keep talking about it, but also rate sensitivity. When you look at it, the 10-year is up 1/4 percentage point from the lows of October, and we think that there's more upside risk here to longer-term yields, regardless of what you see of rate cuts throughout the course of the year.
Your fair value range is 7,200 to 7,400. Dan painted a pretty positive picture. This sounds like a little bit cautious. What say you?
Well, I think that what a lower return year translates into is effectively that valuations stay where they are and the best we get is earnings growth. But what's fascinating is that's effectively what happened in 2025. We started the year at 22 times, we ended the year at 22 times, and the earnings upside is what drove all of the gains in the market. And what that means, though, is that if you don't have a lot of room to absorb a higher multiple or more multiple expansion, it just suggests that you can see some volatility along the way. I think a key difference versus last year is that for the last 6 months, we've been raising earnings estimates. For the 6 months going into 2025, you were actually cutting earnings estimates. So you had a lower bar. Now you're sitting at $310 a share, 15% growth for this year. It's a pretty high bar to jump over.